Hello everybody, Ignatius L. Jackson CPA here with another exciting video for you on the Ignite Business Talks podcast. All right, so today we're talking about depreciation. So the topic's depreciation today. All right, so we're talking through some of the key things you want to keep in mind regarding depreciation going from 2023 and onward. Okay, so go ahead and stay tuned. We're going to be right back in a second. And if you have not already, don't forget to like, subscribe, and share this video with all your great friends. All right, talk to you guys here in a second. All right, and we're back. Thanks for tuning in, everybody, to the Ignite Business Talks podcast. So today we are talking about depreciation. All right, so depreciation is a pretty cool tax feature. Okay, it allows you to write off long-term assets over a period of time. And right now we even have something called bonus depreciation. There's also something called Section 179 depreciation. Okay, so what does all this mean? All right, so ordinarily speaking, if you have a capital asset that you purchase for your business or rental properties or whatever's kind of got business income associated with it, you generally have to capitalize that item and depreciate it over a period of time. It could be 3 years, 5 years, 7 years, 15 years, 27 and a half years, 39 years, etc. Okay, so there's a period of time that you have to amortize or depreciate it over. And so what you end up having to do is following this schedule from the IRS. Usually you're going to use MACRS depreciation. I forget exactly what it stands for. I think it's Modified Accelerated Costs Recovery System. I think I just pulled that out of my you-know-what. So I think that's the right definition, acronym for it, or definition of the word MACRS, okay? So it's a form of tax depreciation that you basically get to take. There's a calculation that you go through, and that's how you get depreciation on your tax return, okay? So the question then becomes, all right, what is bonus depreciation? Okay, so I think everyone understands the basic depreciation concept, right? You get to take that amount over 5 years, 7 years, however long. So it's not exactly straight line, right? There's more depreciation on the front end and less depreciation on the back end using the MACRS system. But now we're talking about doing bonus depreciation. So last year in 2022, we had 100% bonus depreciation on most assets that are less than 20 years life, okay? However, starting in 2023, that 100% bonus depreciation starts to tamper down 20% each year until it phases out to zero altogether. And so we're back to just regular depreciation. So in 2023, it's 80% bonus depreciation, and the other 20% gets depreciated over the normal life period that would typically be depreciated over. And then you have next year in 2024, it goes to 60%, 2025, 40%, and so on until we get down to zero. Okay, so that's how depreciation, the bonus depreciation, is currently working. Now, typically, this is going to be available to you on most business assets. Okay, like computers, pieces of equipment, even some leasehold improvements, depending on the type of leasehold improvement. Vehicles, depending on the type of vehicle it's eligible for as well. So there's a lot of opportunities to get some bonus depreciation going for you, okay? Even in cost segregation study scenarios, we can do bonus depreciation as well, okay? So the two key categories where it's typically not going to be allowed would be real estate, all right? So the building cost that you can't cost segregate and consider personal property, right? Those are going to be depreciated over 27 and a half years or 39 years, depending on the type of depreciate or the type of property that you have. Okay, and the rest of it would be eligible for bonus depreciation if it's not in that 27 and a half or 39 year bucket typically. Okay, so yeah, that's where we kind of get into the cost seg stuff that we've talked about before. That's the bonus depreciation that you have available to you. Okay, now Section 179. That's another form of depreciation. It's a special section of the tax code that allows you to do 100% depreciation on an asset, certain types of assets. Again, real property is not included in that. Okay. But things like certain vehicles, equipment, computers, all that kind of stuff would typically be eligible for Section 179. And what you're able to do is basically take 100% depreciation. However, there's one key distinction, between Section 179 and bonus depreciation. Okay, what is that? Section 179 depreciation. All right, you have to have taxable income in order to take the full 100% depreciation, whereas bonus depreciation can kick you into a loss. So Section 179, the best you're going to be able to do is zero out your taxable income. With bonus depreciation, you can actually kick you into a loss on the business income or taxable income from the business, and you can use that to offset your other ordinary income that you might have, like from your W-2 job or something, stuff like that, right? So that's where a lot of the strategies in relation to real estate come into play, is using bonus depreciation, not using the Section 179 depreciation, because Section 179, you're limited to only the income that you earned from that activity, which would at best zero you out. It's not going to give you amounts below your taxable income that's going to allow you to offset some of that ordinary income. So that's the key differentiation between 179. So a lot of people are like, "Whoa, bonus depreciation is tampering down, sure, but we still have Section 179." Okay, yeah, but it doesn't really work for real estate people, okay? Because you can't take that down past zero. And with real estate, one of the key things we're trying to do is to create bigger losses that we can use to offset our other income that's ordinary income, right? So whether it's from flipping, construction company, W-2 income, etc., we're trying to offset that other income and lower our overall tax bill. So Section 179 is not always going to be the answer if you're in the real estate field, and you're trying to utilize that to help tamper down your real estate losses. However, if you have a big, huge profiting business that profits a lot of money, then Section 179 is great for you. You can go buy a SUV or a truck in that business, do Section 179, you still get 100% of that deduction in the first year. Okay, so that's really the key difference that I wanted to kind of make stress and make sure I explain to you guys, so you kind of understand, like, hey, what is that? Now, also, I wanted to bring up something called depreciation recapture. So depreciation recapture is an interesting concept, right? So you have to be careful with depreciation recapture, in terms of doing cost segregation studies and then, selling a property shortly thereafter, or taking bonus depreciation and then selling a property the next year. So important to note that if you take bonus depreciation in 1 year and then you sell the property in the next year, you have to recapture that depreciation that you took. And it can either be at your ordinary income tax rate, depending on the type of property, or it could be at a lower tax rate, depending on what your ordinary income tax rate is, of anywhere from 15% to 25% typically. So depreciation recapture, actually, let me correct that. I think it's 20% to 25%. I can't remember off the top of my head. I know the max, a maximum rate, if it's like real property, is 25% depreciation recapture, but I can't remember what the low end of that is off the top of my head, so I apologize. Don't quote me on that. But yeah, so basically, you have depreciation recapture when you are dealing with real property and personal property. It happens for both sides of that equation. Some types of property are at ordinary income rates. Some types of properties are at a lower depreciation, a special depreciation recapture rate. But nevertheless, it is something you have to be concerned with, because you don't want to take a bunch of depreciation up front if you don't plan on holding on to that property long term, typically. All right. Unless you're going to have a higher income in that year than you're going to have in the next year. So if the next year your income is going to be a lot lower, then okay, I can maybe see the point to that, versus having all that income in that another year. So there's some strategies where we can kind of play around with that a little bit. So we always want to think through, okay, what's your plan with the property? All right, that's going to guide us on, should we elect out of bonus depreciation? Should we do bonus depreciation? Should we do a cost segregation study? There's a lot of factors that kind of go into that equation to determine what you should do for a particular property. So long story short, talk to your accountant about these things. Make sure you guys are strategizing a little bit. Make sure they understand what your overall goal is for a particular asset. That you're not just trying to do something crazy like write off a vehicle every year. That doesn't work. Okay, so newsflash: when you write off a fully depreciated vehicle in 1 year, and then you go trade it in for a new vehicle the next year, you're not getting the full depreciation amount for both those years. All right. So, because you have to recapture some of that previous depreciation that you took when you go and trade in that vehicle the next year. So, you're not getting the full thing. So, you're just basically wasting money. I can't stand it when I see people doing this all the time. They're like, oh, I got to go buy another vehicle. No, you don't. Only buy the vehicle if you actually need to buy the vehicle. Because especially if you took bonus depreciation, because you're going to have a huge recapture amount that's going to offset any other additional depreciation you might get from buying that new vehicle. Okay, so just kind of keep that in mind. It's not necessarily beneficial to buy new assets every single year, especially if you're selling them or trading them in to get that new asset. So nevertheless, that's my topic today for depreciation. Hopefully that was insightful and helpful to you. Feel free to leave us a comment, give us your thoughts, concerns, etc. And also in regards to like the channel, don't forget to subscribe, like, and share the channel on all your social media. We want to kind of get this word out to more people. And we're going to probably talk through some more personal finance type tips here in the near future. So go ahead and stay tuned. We're going to be right back with some more cool stuff in the near future. Hope everybody has a good one. Bye.